But let's kick off with Mike Muller, head of Vitol Asia. Mike, I suppose the month in review has got a few things in it, but the most immediate and welcome your thoughts on is the OPEC Plus decision last week to roll over their cuts for another few months, or as it would maybe more appropriately phrased, have decided not to increase supply from January 1st. Oil prices had kind of that built in, and since the decision mid last week has come off a few dollars now, trading a little bit above $71 on Brent. So, Mike, your thoughts on the decision and the direction of travel for this market now that that decision is behind us?
Yes, I think it's fair to say the market got what it expected, more or less. So the continuation of the cuts is, of course, a question of adherence and plain evidence. And some saw this as a major success for OPEC and OPEC Plus, on the basis that people had downplayed the change of a face-to-face meeting to a virtual online meeting. Some read into it because there was a slight deferral in the agenda and the timescale, that was evidence that there was a requirement to do more behind the doors diplomacy. But the result was very much what the market was expecting and the market needed. And out of it, we have a strong cohesive message from OPEC, OPEC Plus, that the market can work with. The problem is it also signified an acceptance on the part of OPEC Plus that number one, demand in certain important growth markets in the world, notably China, remains disappointing, and an acceptance also that non-OPEC production increases next year will, for the most part, satisfy global demand growth. And hence, the challenge that OPEC Plus need to face is that they need to keep supply off the market for yet longer. Rather telling, however, that there was emphasis on adherence from certain countries that were named, and most importantly, that the phase back to full production capacity was extended to very much the end of 2026. And people then run their balances, and they still see stock builds for the most part. Some consulting shops now have the market a lot more balanced than next year. One even has the market drawing. But I think most people still see the challenge in OPEC's hands. Should there be disappointing demands? Should there not be an extremely cold winter drawing away at inventories? Should there not be a disruption of a major supply source? And the only one people can think about is perhaps increased sanctions on Iran, causing there to be a market drop in Iranian availability to market, further underlined by another set of sanctions on ship owners, for example. Failing all that, the market still has to contend with builds. That said, we're in the top demand period of the year right now. We have crude stocks drawing somewhat, product stocks building, and product stocks are seen to build through Q1. That's normal seasonal behavior. We do have rather interesting early refinery turnarounds in January, and therefore we have a phenomenon where the market is currently rebuilding inventory after refining capacity was temporarily in October taken back because margins had been quite poor in September. And the prospect now is such that we're not going to see quite the volume of products restocking and products builds. You're likely to see more crude inventory coming back into the market. The market is less supplied than it was at certain times in 2024 in terms of inventory, and that's normal at this time of year, of course. But it gives some cause for optimism. And I think the one conclusion most people are drawing is the availability of crude next year will be such, ample, if you like, will be such that the prospects for refining margins are looking a lot better in people's minds than they were when we had run cuts and pretty nasty margins. Well, that's a strong word. Pretty poor margins at the end of Q3 and early in Q4. So the market got what it wanted in short, and I think OPEC did what they needed. And I think Prince Abdulaziz bin Salman was quoted as saying this was a reality check and a necessity.
Just to pick up on your last comment, and the one I think, as you noted, the Saudi energy minister mentioned in his interviews around the meeting last week, which is the idea of a reality check. It's a quote, it's one to take out, but ultimately, what's your interpretation of what that means? What sort of reality check does OPEC Plus oil producers have in mind, and do they have the right ones?
No, it's very simply acknowledgement that global oil demand in terms of year-on-year growth has been revised down by everybody. to a point where if you exclude NGLs, growth in NGLs is coming because there's obviously an onset of plenty of extra natural gas projects around the world, LNG projects, etc. The net growth for oil that goes into traditional refining processes is less than 1 million barrels a day in most people's books year on year, which is back to or slightly below trend line, if you like, after a set of years where growth was a lot more healthy. Much of which, of course, was still the recovery from COVID demand shock. And in certain parts of the world, the aviation sector still hasn't quite returned to those rosy levels, of course. So that's it. That's the long and short of it, I think. The That's what I think is referred to by a reality check. Of course, there's a lot of watching of actual output and statistics, and a lot of focus on shipping, and a lot of focus on sources of sanctioned oil because they are such significant amounts of oil coming into market, and we mustn't take our eyes off Russian supplies because that is a very, very massive piece of the equation.
And Mike, just to follow up on the same question with Christoph vis-a-vis the month in review, that Trump's return, and now we've a month sort of a window on how he's putting together his team and policy and the energy side and so forth. Going into or through the election cycle, it was always seen as, the famous comment, drill, baby, drill, more oil, more gas coming out of the US under a Trump presidency. Your thoughts a month in? Do you expect that into the new year? Will that just sort of magically be a factor that has to be taken into consideration in 2025?
It's super hard to form an opinion on this. So, I mean, colleagues and friends in the US, I wouldn't say they're divided. They're all pretty neutral on whether a Trump administration incoming in January is going to be bullish or bearish the oil price. Of course, it would suit him to have a little bit of deflationary factor from lower energy costs, but the US economy, as we all know, is pretty self-sufficient in hydrocarbons. So, if anything, they're exporting diesel, crude, and natural gas in a pretty big way. And as you said already, I mean, he's likely to be less restrictive on opening up certain areas of the country for environmental reasons to drilling. That's that little catchphrase, baby drill, yes. But I think a oil price that would move into the 60s, I mean, WTI is already in the high 60s, Brent's holding 71, 72, is not a price that OPEC should be all that unhappy about given the current set of circumstances, but is also not a price that consuming nations are struggling to accept. Indeed, the best bellwether of acceptability of prices in terms of balancing budgets of energy consuming nations, energy importing nations, is South Asia and LNG. And we've seen quite a step change there in terms of countries that would normally stop acquiring LNG when the price moves from the $10, $11, $12 per MMBTU range to the mid-teens, or indeed higher now. The forward curve is closer to $20. Those people are now buying. So there's been a bit of a change in acceptance there that's a new reality. And the affordability seems to have, or the ability to pay seems to have gone up. So there are many factors here, but I think the other thing to bear in mind is if you were to see WTI going to the 50s, people will start looking at whether that has people scrutinizing rig deployment in a Permian basin, in a shale environment that has changed a lot from where it was when the prices last dipped, because there's been so much consolidation into the hands of larger oil majors and very large Permian producers. And what it does to the balance sheets of some pretty large listed companies may not be what the Trump administration wants to see either, because then you'll have Exxon's and Chevron's no longer surplusing profits and dividends. Yeah.
Mike, just picking up on that earlier point, the geopolitical price spikes we've seen throughout 2024 when moments of elevated uncertainty came along, most notably Iran, Israel facing off on a few occasions this year. Now with these developments in Syria, it catches at a time when the oil market looks diluted of an oil of a geopolitical risk premium. Your thoughts on that? Do you expect that to return? How do you see the market positioning for this scale of geopolitical outlook uncertainty?
Well, the turbulence in Gaza and in southern Lebanon didn't have much impact because the world or the trading community very quickly concluded that the threat to supplies was limited, contained, and whilst there were some preemptive, precautionary shut-ins of the sort of gas production offshore in the Levant end of the Mediterranean, that didn't last very long. So I think Syria falls into the same bucket. I mean, Syrian oil output and oil exports have been highly informal and overland. at best. So all the oil majors operating in the country have been away for a very, very long time. But I think you look at the impacts and you get very good indicators from the shipping world. If you look at tanker rates, they have all come down quite a lot since the versus the first half of this year and last year's average. And that's a tanker market that's still avoiding the Red Sea because of the disruption threat by the Houthis. You see it in not just the cost of oil tankers, but all other classes of shipping also. That said, you still have rather healthy markets for bunker fuel because the longer distance that's being covered. One of the factors that has been playing in there is shipbuilding. The shipping industry has seen a higher for longer set of rates, and of course that means their order books are swelling and the yards are very, very busy churning out new ships. The other thing I would say about geopolitics is sanctioned oil has managed to find its way into markets at price levels that are astonishingly flattering for the sellers of those sanctioned barrels. The indicator that I would just bring to the fore here is a few weeks ago, a independent refinery in Shandong in China acquired some West African and some Brazilian oil. They hadn't done so for quite some time because they were absolutely saturated in Pacific Russian and also Mediterranean Russian Urals. And I asked my Chinese colleagues what to make of it, and it was, well, the economics of the Atlantic Basin non-sanctioned oil from South America and from West Africa was better. So that's telling us that almost full market prices being achieved for sanctioned oil, despite price caps, despite dark fleets being sanctioned, despite tightening measures on the supply chain, including insurance and banking channels. So the market has become awfully efficient
Well, I
in that
suppose
regard.
the lower the oil price has gone, the closer those two things have come together. In essence, that has made the sanctioned oil. The Russian is what is it, $60 on the price cap?
That's right. But there's another thing that you get when, I mean, history tells us this. When you get lower prices, I'm not talking about $72 Brent, but if it were to dip materially from here, China has a
Right.
tendency to fill up their strategic inventory and their commercial inventory at government direction, and they have quite a lot of space to do that. They also have quite a lot of refining capacity if they wanted to bring it on. So you would normally see a slightly louder sucking sound from from China in terms of strategic restocking.
Closing thought for you, Mike. China. Going into the new year, obviously the big holiday in China, but also how China reacts to this Trump administration with tariffs imposed on China. We've seen them in the last week. Ban the export of rare earth minerals, for example. How do you see China in the first quarter playing out vis-a-vis both its annual cycle, but now taking on board China tariffs? Economic growth might be more difficult. Your thoughts?
Yes, I'm not always fully aligned with Christoph on China. I've always been a little bit more upbeat. I think China is all about petrochemicals. That's the story. The investment that's gone into petrochemicals capacity is mirroring an expectation that there'll be phenomenal growth in petrochemicals, unlike oil. And that's why you've seen a strong pivoting of all new refining projects into almost using up the entire output of the refinery part of a petrochemicals complex with petrochemicals. So we think that deserves some credit. And if you look at oil demand growth in China, it is a very, very large way naphtha and LPG. Those are very, very large and growing trade flows, and most people are deploying a lot of effort there. The other point I've already made, which is that China is likely to look at its strategic inventories should oil prices go any lower. And of course, China will continue to find ways to benefit from sanctioned oil, as does India. And that's something that has been largely contoned and not interfered with. And I guess many people are now eyeing up the Trump administration to see whether there's going to be any tit for tat tariff escalation, which could also impact oil supply flows into China. But yes, in summary, it's all about petrochemicals. China has the capacity to grow, but urbanization and population growth is kind of done. And as such, we think a lot of China's growth is going to be Chinese money being deployed overseas in the Belt and Road parts of the world. And one such example would be the refinery they built in Brunei, for example. So there's the potential for a bit more of that, we feel.